This episode is brought to you by Katana, a DeFi-first chain built for deep liquidity and high yield. You'll be hearing more from them later in the show. Blockworks Digital Asset Summit, which is crypto's premier institutional event, is back in London October 13th to 15th. It'll have speakers from leading global funds, financial institutions, DeFi protocols, crypto companies, and policymakers. Think BlackRock, Circle, Coinbase, the UK Parliament, Jito and Marinade, all under one roof. Notable names include Joe Lubin from Consensus, Hadley Stern from Marinade, Rebecca Reddick from Jito Labs, a whole bunch of Blockworks folks, and more to come. There's a VIP dinner October 13th, open to speakers and VIP ticket holders only. That will sell out, so act fast. And it's all going down at Old Billingsgate, London. Use the code LIGHT100 for £100 off at checkout. We'll see you there. Nothing said on Lightspeed is a recommendation to buy or sell any investments or products. This podcast is for informational purposes only, and the views expressed by anyone on the show are solely their opinions, not financial advice or necessarily the views of Blockworks. Our hosts, guests, and the Blockworks team may hold positions in the company's funds or projects discussed. Hello and welcome back to another episode of Lightspeed. I'm your host, Jack Kubanek, joined today by Michael Marcantonio, head of DeFi at Galaxy, a firm that is doing a lot of interesting things in crypto and especially in Solana these days. So very excited to have him on. Michael, thanks for joining me in the studio today.
Jack, thank you for having me. I love this podcast. I'm so excited to be here. Let's hit it.
Yeah, we heard off the air that you're a regular listener.
I am.
So if you're a regular listener, you're in good company. There's very smart people that listen to Lightspeed. I wasn't sure if this was true, but
one of the
gave me hope.
This is one of the best podcasts out there. Okay, I am a subscriber. You should subscribe. And you should follow. And Jack, pleasure to be on. Very excited.
Thank you. Your check is coming in the mail soon. Michael, I don't want to bury the lead too much here. I got interested in having you on because you were sort of tweeting a bunch about Solana. Galaxy, the firm is involved in Forward Industries, the new sort of multi-coin jump Galaxy Solana DAT. And you were not a name I was familiar with as familiar with before this all happened. But I kind of just wanted to ask, what is your general Solana thesis? What has you so bullish on Solana these days?
So let me break it down a little bit. First, by talking about the world we live in today. The reality that we live in today is a reality in which the global financial system is a fortress of intermediaries, powerful intermediaries, banks, clearinghouses, giant financial institutions that hold monopoly power over the flows of global capital. That's where we live in today. And throughout my entire lifetime, this system has not benefited average people. In fact, it's been quite the opposite. We've seen the top 1% gain exponentially in growth and wealth, while normal people are not only not doing well, but are not doing well because they can't get access to capital. These are very powerful institutions that with a maze of regulations that sort of covet and protect the core financial interests of the world. And it's been largely to our detriment. And it's ripe for disruption, right? So in August of this year, something that I don't think has gotten enough attention is the current SEC chair Atkins, laid down the gauntlet with Project Crypto. And what he said was, the core financial machinery of global capital markets must move on chain. And when you think about it, now is the time for it to move on chain. So as head of DeFi at Galaxy, we look at all the blockchains and we say to ourselves, which blockchains are best suited to absorb the $500 trillion global capital market, right? Which blockchains can do that? And we looked out at the market, and we have been for a while, and we say, there's really only one blockchain today that can absorb the global financial machinery of not just today, but tomorrow. And that's Solana. And so we made a big investment in Solana, and we have been for a while. And my team's focus has largely been on Solana. And let me paint real quick for you what our thesis is. By the end of the decade, Solana is going to trade the majority of publicly tradable tokenized securities. It's going to trade them on rails where there are 20 millisecond block times with multiple concurrent leaders with 1 million transactions a second. That is our thesis. And when it's able to do that, it is not vying for the best decentralized network. It's not vying for the best blockchain. It's vying for global world supercomputer status. To me, this is exactly what we're playing for. Solana seems to be the most suited blockchain to do it. And in so doing it, what you're going to find is Solana grows out of just being a blockchain. And now we're looking at Solana as the digital Suez Canal, the digital Panama Canal, the digital Strait of Hormuz, right? It is going to evolve from just a digital network to a global geopolitical force. And that's what we're so excited about.
The digital Panama Canal is awesome. Thank you. Thank you. Why? So maybe to set up this next question, because I want to ask like how you went on that journey, because Galaxy is not inherently like a Solana centric company or anything like this. What does the DeFi team at Galaxy do? Like what kinds of things are you actually doing on chain?
Right. So Galaxy is probably the largest publicly traded company in DeFi today. Like you look at all the publicly traded companies, we are the ones on the forefront of building technology to unleash high frequency trading at scale on decentralized networks. And we've spent a good amount of time, probably the majority of our time, focused on Solana. We think it's the most purpose-built for high frequency trading. We think it is the most sophisticated. We think it is the most scalable. And frankly, while it's somewhat difficult to get started on Solana, once you're on it, you see all of the power. You see the throughput, 65,000 transactions a second. By next year, I suspect it's going to be 150,000 transactions a second. By the end of the decade, especially with multiple concurrent leaders, we're going to see 20 millisecond block times. We're going to see 1 million transactions a second. And that is what is required to build the execution layer of the global securities market, the tokenized securities market that Chair Atkins is talking about, that BlackRock is talking about, that everyone's talking about right now. And so we build high frequency trading systems. We look at all blockchains. We love every blockchain, but we think the clear leader right now in blockchains for global tokenized securities trading is going to be Solana.
Mm-hmm. And why is it important that it's Solana, say, that or not important, but why do you think it's the most likely that this transformation is going to happen on Solana as opposed to, say, Stripe's L1 Tempo that it's building out, or some kind of other corporate blockchain of which we've seen many and probably will see more in the near future? Why is it going to be on the decentralized?
Yeah, it's a great question. The bet that we are making is that Anza, Firedancer, and the entire ecosystem on Solana can move faster at hitting a point of velocity sufficient to absorb the $500 trillion of global securities that are traded every year. What I mean is this. Sure, Stripe could really propel that chain to be as advanced and as sophisticated as Solana, but it's playing catch up. We think that Anza, we think that Firedancer, we think that the ecosystem operating both in a decentralized way is going to always be a couple of steps ahead of the best. Now, this is not to say that Stripe or let's say Nasdaq chain, if it ever came out, couldn't compete with Solana. But the question is, can they be better than Solana? I don't think that's possible right now. It's obviously a big fight, right? And Solana has to be very focused on the goal, which is the IBRL thesis, which is increasing bandwidth, reducing latency, scaling, speed, like being able to absorb the billion number. It's about 1 billion transactions a day that are executed on the current global securities market, right? Can Solana do that? Well, Solana can do it today, right? If you add up the number of transactions that Solana can execute per second, it could actually warehouse the total number of executed transactions. But of course, Nasdaq doesn't just absorb executed transactions. It also absorbs packets for cancels and everything else. So it has some room to still scale. I venture to bet that about 1 million transactions a second will make it very competitive with Nasdaq. But when you look at Nasdaq versus Solana, you can't just look at tick to trade. You also must look at the T+1 settlement. And when you factor in T+1 settlement, no centralized system today, especially in TradFi, can compete with any decentralized network, right? You get instant settlement, and with Alpenglow, you're going to get settlement between 100 to 150 milliseconds, right? When you look at that versus T+1 settlement with Nasdaq, you're not going to be able to compete. Now, could Stripe come out with more competitive technology? Of course. But then that really undermines the decentralization thesis, which is that eventually you will hit escape velocity, which a decentralized network can advance and innovate faster than any other centralized system.
Have you, as an aside, have you always been this bullish on Solana? Like this is one of the most bullish openers we've had maybe ever on this show. I'm curious, like at what point you became this convicted that like Solana is the one?
So every blockchain that I talk about and every blockchain that I am in favor of or against, I use, right? I build on, right? I build applications. I build trading systems on them. So listen, I love Ethereum. I love a lot of the L1s. I love a lot of the L2s, but they simply cannot match the throughput and scalability that Solana can. Now, can they catch up? Sure, it's possible. And that's why Anza and FireDancer and all the other players need to be really focused. And Galaxy, frankly, we build a lot on Solana. But I became really bullish around last year when I started to see the real power. So there's something that's really interesting. If you watch like crypto YouTube, like, you know, not the established players like yourself, but like sort of like the underbelly of crypto YouTube where they're really just pumping prices, right? What you'll see is a lot of influencers, I'll call them crypto influencers, that will always talk about like different blockchains and how fast they are and how many transactions they can execute. But then the question is, okay, they can potentially do that. Do they in fact do that though, right? Mm-hmm. Like, and Solana is the only blockchain that not only can absorb 65,000 transactions a second, but actually does it, right? Solana has consistently had the highest volumes over the last 18 months. Solana has consistently had the highest rev over the last 18 months. Rev is not just a proxy for like making money for businesses that are on chain. It's also a proxy of, do you as a user want to use that blockchain? And do you get enough value out of it relative to any other network that you're willing to pay for it? It's a massively powerful metric, and Solana has been crushing it on that since. So based on those metrics and our ability to build on Solana and trade on Solana, we think that just the ceiling is very high, and we think it's very much in the prime position. And that's why we, a core group of us within Galaxy, really push for getting into the DAT game.
Katana is an L2 built for DeFi, and it's pioneering the ecosystem category of productive TVL, believing that chains should be graded on how efficiently assets are put to work in DeFi, rather than just total value locked. In just a couple months, Katana has surpassed $500 million in TVL, with over 90% of that TVL being productive in ecosystem on apps like Sushi and Morpho, which also receive boosted yields from Katana's unique Vault Bridge design. From now until the end of November, users that bridge to Katana can earn boosted yield from CAT incentive campaigns, added Vault Bridge yield, and other chain revenue. Major app launches will be coming down the pipeline in the next few months, with incentive campaigns for the Kensei Memecoin Launchpad and Perpstex partners for Katana. With the launch of Katana's chain-wide V tokenomics model, VCAT holders will be at the middle of the Katana flywheel, directing emissions and earning fees for their votes from partner protocols. Thanks, Katana, for making this episode possible. As always, investments in blockchain technology involve risk. Terms and conditions apply. Do your own research. The DAT game you mentioned, Forward Industries, the largest Solana DAT as things currently stand in terms of how much SOL it's acquired. There's also just been a lot of, Kyle Samani, the chairman, has come out publicly and said that Ford is going to be deploying into DeFi. It's going to be staking. It's going to be doing these kinds of things. It's also something I've seen you tweet about. I guess you were in some capacity involved with this DAT. What's your pitch on Ford? Like, why do you think this is a worthwhile investment for folks?
Let me first pitch you on SOL DATs generally, right?
Sure.
And like why DATs actually make sense. Because you've actually raised, because I watch all your podcasts, you've actually raised many times some skepticism about MNAV.
I have,
right?
Yeah.
Let me sort of walk you through my take on how this works, right? MNAVs are justified for well-ordered and well-managed DATs because DATs are actually providing superior leverage than all other potential vehicles for traders and for investors. Let me give you an example. Let's say you have a thesis. Let's talk just about Bitcoin, but it also applies to Solana. Let's say over the next 5 years, you think Bitcoin's going to $1 million of Bitcoin, right? For most people, if you're very convicted in that thesis, you wouldn't just want to buy and hold Bitcoin. You'd want to buy it and hold it with leverage. But what leverage do you, Jack, have access to as an individual? Let's say further, you run a fund. What access do you have leverage to? So what leverage do you have access to? You actually only have really three options. You can buy levered ETF shares. You can have a fund or as an individual trade on margin, or you can buy a DAT. Now, why are the first two options not optimal for you? Well, leverage ETFs reset every day. And you have something called volatility drift or volatility slippage, in which what will happen is every day with a volatile crypto, if it goes up 10% on a Monday and down 10% on a Tuesday, if you just hold the underlying, you will go up 10% and down 10%. So you'll be roughly 99% of what your initial investment, if your initial investment was 100. But if you're 2x levered, you go up 20%, down 20%, you're actually at 96% after the second day, right? So actually, levered ETFs don't provide you and don't outperform the underlying for long-term holders. Let's talk about margin, right? If you're a hedge fund, you have to borrow on inferior terms as any publicly traded company. You have to borrow by securing your borrow against the value of your currently held assets. And you not only get margin, but you're subject to margin calls, right? This is the worst thing that can happen to you if you are a long-term hodler of Bitcoin or Solana, right? You have a long-term thesis, you've got 2x, 3x leverage on your holdings, and all of a sudden, in the middle of the night, the price of Bitcoin goes down 30% and you get liquidated. It's happened to us all, right? That's not a good form of leverage for you, right? Enter the DATs. MicroStrategy pioneered this strategy, which is converting volatility into increased equity gains. How do they do it? Well, they do it through a bunch of different, very novel, creative strategies. One way they do it is they leverage up their volatility by issuing convertible notes to the market. And these convertible notes are superior to any leverage you have access to as an individual. They're superior to any leverage that any fund has access to. Because they're a publicly traded company, they can issue convertible bonds to the market. And those convertible bonds, they can issue at almost zero coupon. They don't pay an interest rate on those bonds, and they can issue them for 5 years. What does a 5-year debt instrument look like? It means you can weather the short-term volatility, right? And you can weather it. Like, I remember in 2022 when Bitcoin crashed, I immediately looked at MicroStrategy. I was like, oh my God, MicroStrategy is going to get liquidated, because I didn't know anything about MicroStrategy. And I didn't know that actually they weren't borrowing against the value of their underlying Bitcoin assets. They were borrowing against the value of their stock, and those were fixed term notes for 5+ years, and those notes didn't come due yet, right? So it's a superior form of leverage because you can issue convertible notes to the market, and the reason why you can actually charge no interest rate is because what the buyers of those notes are really looking at is the embedded call option within the notes, right? And so what that means is the more volatile a underline is, a Bitcoin DATS underline, which is Bitcoin, or an Ethereum DATS underline, which is Ethereum, or Sol DATS underline, which is Sol, the more volatile that underline is, the more actual access to very favorable borrow terms you have by hitting the convert markets. So Bitcoin has a beta of roughly, Bitcoin's volatility is roughly 41% on the year. Ethereum's is about 51, 60%. Solana's, last I checked, was about 80%. Solana's almost 51% more volatile than Bitcoin, which should mean that a Sol DAT can issue more favorable convertible notes to the market. And what are DATs but issuing convertible notes, issuing equity, issuing preferred stock to the market, raising, and then having a long horizon window to accumulate Sol per share faster. So when you look at this, you say to yourself, okay, if Sol is more volatile than Bitcoin, and MicroStrategy's success has been in converting its volatility of Bitcoin into equity gains for shareholders, it just follows that Sol could be way more powerful of an underline for a DAT. And that's why that's one of the reasons we decided to get into the DAT game. It's a very powerful volatility core raw material that a DAT should propel a DAT to be able to accumulate more Sol than anyone else.
Okay, interesting. The volatility point is not necessarily where I thought you were going to go.
Well, that's on the DAT thesis generally, right?
Sure. Okay. This argument, I guess, depends on the premise that leverage is like a good thing. But if you're buying crypto with leverage, you get leverage upside. You also get leverage downside, which can be pretty negative. And MicroStrategy has seen some big drawdowns when Bitcoin has as well, right? With a lot of these crypto assets, I wonder why you necessarily need leverage, because you're buying Solana in hopes that it's going to 10x or whatever. Like, you already are expecting outsized gains.
Yeah.
So I guess I maybe take a bit of issue, and I'm a little bit playing devil's advocate for the sake of this pod, but with the fact that you need leverage at all. I guess the other question that I've raised throughout DAT mania is that, in order for Forward Industries is pursuing this DAT strategy kind of in hopes of making the price of Solana go up, giving people access to the price of Solana as it goes up. I could also just buy Solana and, actually what you're referring to with an MNAV is that the market values the shares above the value of the Solana within the shares. And so if I buy Solana, I'm technically getting like a better deal, I guess, than if I were to buy shares of a DAT. That's not true if you can increase your SOL per share over time. But my understanding is that that's difficult to do unless you're basically selling additional equity to the market at like worse or at an elevated MNAV over and over again. And so my concern is, like, if we get to a point where you can't do that anymore, do shareholders end up getting wrecked because suddenly they're extremely diluted with the terms you have to issue equity or something like this?
So the risk is that a DAT, and it's not just a SOL DAT, any DAT, doesn't strategically issue equity that is accretive to shareholders, right? The thesis, of course, is that if you issue equity to buy a more valuable underlying asset, namely SOL or Bitcoin or Ethereum, then actually it's accretive to shareholders. But I was talking about something a little bit different, which is convertible notes only dilute shareholders if the stock price goes up significantly, right? If there's a premium that it's hit. And because of the volatility of SOL, you're more likely to hit that premium, hit that premium and therefore exercise the embedded call option within convertible notes. And therefore, lenders will lend you money at cheaper, better rates, right? So yes, but like that is a call that I think many equity holders would make. Like, all right, I'm willing to own this equity, and if it goes up 35% or 40%, then of course we're going to get diluted somewhat, but now we bought a lot more SOL, and the stock price has gone up significantly, right? But it gets better for SOL DATs. And this also applies to a lesser degree to ETH DATs, but SOL DATs are just more powerful because, one, they're more volatile, but two, staking rewards, right? So yes, there is some risk to issuing convertible notes. Namely, in 5 years from now, you might not have the capital to pay it back, right? When the debt comes due. Of course, MicroStrategy has innovated around that and issued preferred stock. We could talk about that. But for convertible notes, the risk is in 5 years from now or 7 years from now, whenever they come due, you don't have enough capital to pay them back. Of course, a SOL DAT is in a better position there because.
And can I cut you off?
Yeah.
If that is the case with these convertible notes, is there a world where DATs become forced sellers of their underlying Bitcoin or Solana or whatever it is?
So the only circumstances I can envision in which they are forced sellers is under two circumstances. First, they cannot pay back their convertible notes. Now, incidentally, no SOL DATs, and as far as I know, no ETH DATs have even tapped the convertible debt markets yet, right? So they have no debt right now. So as long as you do not lever up your ETH or Solana or Bitcoin, you have no risk, as far as I know, of forced selling, right? Because you're just going to hold it in perpetuity. The only time you have risk of forced selling is, one, if you issue convertible notes that you have to pay back, and two, you don't have enough capital when they come due in the future, which would be 5 years, 7 years from the date of issuance, to pay back those notes, in which case you either have to borrow more capital to pay them back, or you have to sell. So the question is this: if a company, let's say call it a SOL DAT, let's say you're a $10 billion sold at. You hold $10 billion just to make the numbers easy, which is not that hard to believe because BMNR right now is an ETH debt that's roughly worth $10 to $11 billion, right? If you're a sold at worth $10 billion, today, you are going to be generating between $700 and $800 million of free cash flow just by staking your SOL. And you don't have that many expenses or that many costs. So this is the second really powerful point about why SOL DATs are quite interesting. Because they're like, you can do everything that MSTR can do, but you can do more on better terms because you have this massive free cash flow machine, right? So imagine you're a SOL DAT and you're generating $700 to $800 million of free cash flow a year. And the moment you get those rewards, the moment you get staking yield, you convert it to USDC and hold it as reserve, right? Now, you're not aggregating SOL per share, but you look at it and you say, well, I can aggregate a lot more SOL per share just by hitting the ATM, hitting the open market for converts or for new equity issuances. I can raise a lot more capital that way. I want to have a little reserve fund, or it's a big reserve fund. That plus the fact that DATs don't really have any expenses, right? You can start to see how investors will actually give you more favorable terms for your borrows, your long-term notes, than even MSTR or even an Ethereum DAT, which would have similar terms, but because of the 3 or 4% yield on Ethereum versus the 7 to 8% yield on Solana, you actually can see a much more lucrative SOL DAT there. So it actually makes it safer, right? If you think about it. And so those are the only circumstances. Now, if you don't touch leverage, to be clear, there's really no forced selling. The only way you could have forced selling is if there's a hostile takeover of your publicly traded company, and the hostile takeover, its goal is to take over the company and then sell the assets because the assets are more valuable than the NAV. But most publicly traded companies have faced this risk for years, right? Like literally since the 80s, you've had hostile takeovers, and there's a lot of protective measures that corporations can employ in order to protect themselves from getting hostilely acquired.
Speaking of hostile takeovers, I was having an interesting conversation this week with a listener of the show who will DM me on Telegram now and again with some of his thoughts, and he was raising this idea of like, couldn't DATs essentially pursue hostile takeovers of like apps on other ecosystems? Like if you have this big treasury, you like the Fluid DEX. This couldn't actually happen, but you like the Fluid DEX on Ethereum and you want to bring it to Solana. You acquire a ton of Fluid tokens and then you like become the biggest stakeholder, and then you essentially hostile take over Fluid, bring it to Solana, and you've like acquired a new app for your chain or something.
I think that's fascinating. I've actually thought about this a lot, which is DAO governance, right? And there needs to be, and there is, a lot of improvements there, but DAOs are actually ripe for hostile takeovers. Now, you don't want to incentivize this by any means because it's quite disruptive, but that disruptive force actually forces DAOs and protocols to innovate on their governance. And, over the last 5 years, we've seen certain DAOs that have varying degrees of sophistication on how they're governed, right? And you saw with Arca try to hostile takeover. I forget which DAO it is now, a couple of years back, because they saw that the DAO treasury was greater than the rewards that the DAO token holders were getting. Ultimately, I think one of the stifling things for DAOs has historically actually been the fact that regulation has permitted them from acting more like corporate boards and more like publicly traded, entities than they actually function like. And so with changing in regulation, I do think you're going to see more innovation, but you're completely correct that publicly traded DATs are the apex predators of crypto right now. They have superior access to capital. Like I just talked about debt, but they also have superior access to raising capital. Like think about if you are Fluid, right? How do you raise capital? Well, you could issue tokens, which is effectively a public offering, right? Or you have to go to VCs, right? And going to VCs is slow, it's hard, it's arduous, and there's lockups, right? Now, if we start seeing innovations in capital raising for decentralized protocols, you might see even more superior capital raising methods out of DAOs than you would out of publicly traded companies. But today, DATs have the best ability to tap the largest capital markets and raise capital. And what they do with them is varying, right? They could go hostile, right, over Fluid. And there really aren't sufficient protections on a DAO that there are on publicly traded companies. But that will actually catalyze a lot of innovation on DAOs, right? It'll be very interesting to see. Of course, what the chairman of Ford talks about, Kyle, is about acquisitions, right?
Yeah.
So you might see a lot of consolidation in the DApp market, and consolidation is very interesting because when there's many players, they're all fighting for the same capital, and unless they grow the capital base, consolidation makes a lot of sense.
Or just like, what if you're Solana and you see like Polymarket settles on Polygon, I think, and you go to them and you say, hey, with all this capital we've accrued, we're going to try to acquire or like convince Polymarket to change over to Solana, which I don't think would be that technically difficult based on what Polymarket does. Like that's an interesting.
I mean, yeah, there should be a Polymarket native to Solana for sure, right?
Yeah.
And Polymarket would be smart to launch on Solana, right? At the same time, you could do it the more hostile way. I don't know how you would do it with Polymarket actually, because
it's not necessarily governed by a DAO.
Exactly.
Yeah.
Right. So here's the trick. Like if you're a private company and your tokens do not entitle you, actually to think about it, like you'd have to, let's take Fluid, for example. Like if you bought all the Fluid tokens, let's say, would you be able to, I haven't read the governance rules on this, but would you be able to like force Fluid to move over to another chain? I don't know if you would. I have no idea. It would be interesting. I think there is a separation between like the foundation and the DAO and what the underlying protocol can do. Now,
I would think so.
So let's just like take Jito, for example, because there's a very strict separation of Jito Foundation with Jito Labs, right? Jito Labs builds the tech, Jito Foundation controls the governance token and all that. I don't think taking over Jito Foundation like would force
Jito Labs,
would force Lucas to like move to to Polygon or something, right? Like I just don't think that there's a nexus there. But let's take another example. Let's say, actually, I don't think there's actually a good example. Like, so for example, Jupiter is a good one. Jupiter is a private company, but if you bought all the Jupe tokens, it wouldn't entitle you to governance over Jupiter, right? Like in like a meaningful way that would force Jupiter to either move to a different blockchain or shut down or change its operations, right? But if tokenized securities happened, right? And let's say that Jupiter issued its stock on chain, then you have a real opportunity to do hostile takeovers there. But if they were tokenized securities, you'd also have to follow all the US rules, assuming it's a US company, on how acquiring certain percentages in publicly traded companies works. So in order to take over a publicly traded company today just by open market purchases, it's very difficult.
Yeah. So we're a ways away from this in short.
Yeah.
I want to ask maybe a little closer to today.
Yeah.
You and I cut you off a little bit, but you were speaking about all of the free cash flow that a Solana DAT based on its yield, which we should caveat. I think that when you say that Solana staking has like 7-8% yield, that is nominal yield. That's not necessarily real yield. In some sense, it's like an accounting, like Totali's called this an accounting trick.
Yeah. But it's real yield for the holder, right? Like, so like nobody looks
psychologically,
it's real. Nobody looks at a Bitcoin mining company and says, you're just getting the nominal yield of Bitcoin, right? Like you're mining these Bitcoins and you're just getting inflation rewards, right? Like that's real Bitcoin that they can sell in the open market for real dollars, right? Mm-hmm. And so sure, it's like, it is technically nominal yield, but for the actual validator that is generating that yield and converting it into USDC or, converting it into dollars even, like that is real money coming in. Mm-hmm. Just like a Bitcoin miner generates Bitcoin, just like an Ethereum miner or previously Ethereum miner, but Ethereum validator generates ETH, right? That is real currency that comes in, even though, yes, it is technically nominal, but it's still cash flows, right?
It's still assets that are moving around. And so to the extent that that's useful, it is superior, I guess, to ETH. Yeah. But it's not like new value being created. That, to my understanding, comes from like tips, people paying an additional tip to be included on chain or these MEV tips through Jito. But nevertheless, a $100 billion DAT would have 700 million or whatever in free cash flow. Was that correct? 7 billion.
Yeah,
anyways,
7 to 8%.
7 billion.
Roughly,
okay,
right?
yeah, sorry.
So you've got 700 million. Let's say you convert it immediately to USDC, thereby locking in that gain, right? Or apparent gain, right? That's still real cash that you can use,
yes.
Right?
And so now that you have this cash, what do you actually do with it? Because a lot of Solana DeFi tokens really rallied on the news that Ford Industries was going to be doing this. Camino, Drift, some of the like multi-coin portfolio DeFi companies, I think people thought that they would deploy a lot of its treasury into them. But what does that actually look like? Because you're in some ways you're constrained by what Solana DeFi actually is, which is not necessarily the end state of what people want Solana DeFi to be. So what do you expect to actually be done as far as the DeFi deployment? I've been really curious on this point.
It's a very good question. And speaking of the head of DeFi at Galaxy, you might think I have a very good answer. And I have thought a lot about this, but let me break it down a little bit in terms of like DeFi tiers, right? So in tier 1, there is something that's very powerful about Solana, which is why a Sol DAT actually really is accretive, which is stake weight, right? So right now, Ford has $1.65 billion, rough give or take, of Sol. When it stakes that amount, if it runs the validator, which it does, it now has $1.65 billion of stake weight. What does stake weight on Solana give you? It gives you something. It gives you two very, very important properties that don't exist on any other blockchain. So this doesn't exist on Ethereum. This doesn't exist, obviously, on Bitcoin. You get the power of stake weight, which is to say you get state updates faster because you are in the first level of the turbine tree. How state updates are propagated on Solana is you have the leader, you send your state updates, which means your shreds to a root node. The root node then propagates it to the top 200 validators with the largest amount of Sol. So you get state updates faster than everyone else. That's very important.
And for listeners who might be confused, it's like the state you can kind of think of as like the most updated version of the chain, I guess.
Yes. So price updates, right?
Sure.
If you want the fastest prices on chain,
yes,
you want to be the leader. That's the first one, right? You get the fastest because you're building the block. And then you want to be the root node, like if, that's number 2. And then number 3 is you want to be in the turbine tree, high up in the turbine tree. And the more stake weight you have, the more likely it is that you'll be leader more often, the more often you'll be the root node, and the more often you will be consistently in the first neighborhood of the turbine tree, which is a superpower for a fully integrated DeFi trading, validating stack. So the first thing is you get faster state updates. Imagine you're trading on Binance, and because you own more BNB tokens, you got actually price updates faster. That's the equivalent on Solana. Second, you have stake weighted QoS, which gives you this giant tunnel, depending on how much stake you have, to push your transactions through. So one of the historical problems on Solana, which is aggressively being remedied, is throughput, right? Is congestion. Because transactions are so cheap on Solana, there's a lot of spam, or historically there has been. And if there's not enough throughput, that means that your transactions might have to wait in line to get processed. But the more stake weight you have, the more stake weighted QoS you have, which means the more priority, in effect, your transactions have to reaching the leader. So to summarize, you get these two interesting properties the more stake weight you hold. And it's largely like a linear. It scales linearly. Like the more stake weight you have, it's not perfectly linear, but the more stake weight you have, the more of these properties you get. You get faster prices and you get better execution. Well, what can you do as a DAT with faster prices and better execution if you run a validator? Well, Galaxy, Jump, and Multicoin came together for a reason. Galaxy, top asset manager in the world for crypto. One of the largest footprints of all publicly traded companies in DeFi. Jump, arguably the best high-frequency trading company on earth. One of the best, if not consistently the best high-frequency trading company in crypto. And Multicoin, arguably the most visionary Solana venture fund out there. Most strategic, most visionary. Those three together, what are you going to get? I believe the Forward Industries, the Ford DAT, is going to be building a fully vertically integrated DeFi trading and execution stack. So from validator to RPCs, to trading and execution, to aggregating order flow, every step in the supply chain, the DAT is going to excel at. And so what sort of activities are you going to see? With that sort of execution stack, you're going to see the Forward Industries DAT have arguably one of the best, if not the best, access to market making on chain, to liquidity provisioning on chain, right? To pumping the Solana ecosystem with easy available liquidity, which it definitely needs. This will tighten spreads. This will provide better rates on chain. And this will be something that will accrue to the benefit of the token. And so it's a very smart thing to do.
It sounds almost like you're describing a publicly traded hedge fund in a sense.
That's an interesting take. It's an interesting take. I think of it more as a publicly traded market maker. Vert2, for example, is a publicly traded market maker, right? Vert2 has a fully integrated stack. It's a designated market maker on the New York Stock Exchange. It's a market maker on the Nasdaq, and it has a payment for order flow behemoth that generates a ton of alpha just by buying, Robinhood flow and processing it, right? So, and those dark pools, by the way, for Robinhood are effectively off-chain exchanges. So it looks more like that than it does a privately traded or publicly traded hedge fund. But you could also argue that MSTR looks like a publicly traded hedge fund in a lot of ways, right? It's just got a long position. It's taking a directional bet. It's taking a long with superior leverage and superior capital structure to every other hedge fund out there. So I don't think that's an unfair characterization.
Okay. I guess I'm curious, like my mental model was Ford raises all this capital, it acquires Solana, it then stakes that Solana, and then maybe it, does some, gets some kind of risk-free rate in DeFi where it's like restaking or something. I don't know what that would look like. But it sounds to me almost like you're saying that you can actually trade and like do more active capital management on Solana with through Ford.
So that's tier 1 is trading. Tier 2 is deploying capital in what you just described, right? Sort of looking at a rates arbitrage, right? Saying, okay, I can borrow at this percent, I can lend out at this percent. I've got all of this SOL. If I can beat the staking yield, then I should deploy it in these strategic ways, right? Now, deploying in those strategic ways could be accretive, increases risk, so you have to increase the management, the active management of those assets. But if I were advising Ford, I would definitely take a look at that. It does two things. One, if you can beat the staking rate, then it's obviously creative because, of course, the goal is to maximize SOL per share. And secondly, you're actually providing liquidity to the ecosystem, thereby making the overall ecosystem more valuable, right? Which will accrue to the benefit of the token holder, which you hold, right? So just like BMNR has been like a thought leader on the Ethereum side, I believe Ford will be a thought leader and an active participant in DeFi to take DeFi to the next level. And the next level is, of course, going after the $500 trillion securities market.
Let's talk a bit about the $500 trillion securities market then. Something that you've spoken a bit about is tokenized securities. Galaxy tokenized its stock on Solana via Superstate. And I think, at the top of the episode, you cast this as being very central to the Solana thesis, the internet capital markets future. I guess, like, how do you foresee, or like, what role does Solana play in this sort of tokenized future that we're seeing play out in front of us? And maybe what is the slot for Ford in that as well?
So what role does Solana play? Solana will house, I believe, and is more likely than not to house the global securities market if and only if it can be faster and if it can scale greater than the current existing traditional markets. Sure, there could be a hobbyist market, right? Where it's like, oh yeah, I bought Galaxy on chain because like it was cool to do. But if you're getting worse fills, worse liquidity on chain, wider spreads, it ain't gonna happen. However, to the extent that the mission of Solana is to build internet capital markets and to have the most powerful system on Earth, decentralized system on Earth, to trade securities and commodities and FX and bonds and all of these other things, Solana is the best candidate to do it, I think. And so there is a big opportunity for Solana to be the apex predator of blockchains for the $500 trillion global securities market, but only if it can scale fast enough. And that is a very tough undertaking because, one, you're competing with the Nasdaq where everything is co-load, right? And this is where the MCL thesis comes in and why it's so powerful. Multiple concurrent leaders reframe the question about what tick to trade really means. Tick to trade actually means where the information derives in the world to how close you are to absorbing that information. So if something happens in the Middle East that changes asset prices on the Nasdaq, it's still going to take 75 milliseconds to get there. The Nasdaq is no faster than any other blockchain that can process at 75 milliseconds, right? From absorbing information from the Middle East. But with MCL, you're going to have validators in the Middle East that are incentivized to be in the Middle East, that when they are the leader, they will absorb that information first, right? You think about a globally distributed system and you start to see, holy crap, like this actually could be the Nasdaq on steroids. It's scaling the Nasdaq globally. So, but it has to get there, right? Now, Chair Atkins is very focused on this. I believe, it's my own opinion, we'd already be trading securities on chain if it wasn't for the regulators. Like you would already today be getting a loan on chain for buying a mortgage, or for buying a house with a mortgage on chain. You would today be borrowing not from a bank, but from some credit union on chain right now if it wasn't for regulations. Regulations have thwarted that, but the technology has been there and it's only getting better. Obviously, you have to be very risk averse here. You have to be very cautious because we're not just playing with tokens anymore. We're playing with like people's lives here, right? And if you put, let's say you put Amazon stock on chain and Amazon stock on chain for some reason gets totally manipulated, right? Like that affects real value in real people's lives. However, the thesis is that like, because of the transparency and because it's on a public ledger, those things will be actually much less likely to happen than what they currently happen, which is largely a black box on how they're traded today. They're both traded in dark pools and they're traded on the Nasdaq, and no one really can see what is happening there.
Mm-hmm. I guess to push it a step further, then, if this tokenization thesis is going to actually happen, I think that the financial world needs to be convinced that DeFi solves real problems for them. Stablecoins have been very successful, and I think stablecoins do solve real problems that businesses and people outside of the US have. What problem does tokenizing securities solve? Like what is the actual pitch where you're not just playing with tokens, but we should be, doing real stuff with these tokens?
Great question. It solves many problems. First, the problem it solves is that the global South, if you will, has no access to publicly traded securities in the United States, right? Or in London or in Tokyo, right? It just doesn't. That will change quickly. Second, public securities today operate on a T+1 settlement. So I sell you market maker, you sell me market maker, publicly traded security. It doesn't get settled until a day later. And that's actually a real problem. Like people pay a lot of money in losses or in fees for those settlement times. Third is composability. So, I mean, I'm not telling you anything you don't know, right? Like all of the core attributes of DeFi, atomicity, composability, transparency, right? All of these things are sorely needed in the global securities market today, right? We don't have any transparency over the global securities market today. Because you cannot compose transactions in an efficient way between a security and a commodity and a currency, right? These are separate silos between FIX and SWIFT and all of these different other languages in which different systems communicate. You can't really have a very efficient, like take for example, Citibank. Citibank in 2020 or 2021, I can't remember exactly what year it was. They transferred because of an error, like almost $1 billion to the wrong people in a Revlon payment. So Revlon was owed money. They sent it to the wrong person. They owed $1 billion, and they had to get in litigation for like years over it. Now they won ultimately, but that was a huge, massive issue. This year alone, they had several near misses. So there was a near miss recently where $81 trillion in a ledger error happened, right? Now, why are those ledger errors happening? Because you have to reconcile different ledgers, these siloed, centralized ledgers between each individual institution. You have to aggregate all of those different ledgers, and it gets worse when you hop to different asset classes. So equities might standardize their ledgers, but there's no standardized ledgers between equities and currencies, right? And so all of a sudden you have these different states having to reconcile. We need to get rid of this reconciliation industrial complex. which is to say there's a bunch of intermediaries whose full-time jobs are to reconcile different ledgers every day. If all of these assets traded on Solana, they would in effect be on all one global state. That would be a massive efficiency gain. And what you'd be able to do is you'd be able to borrow against your securities to make a bet on currency markets, or borrow against your securities to invest in bonds, right? And you'd be able to do this in one seamless atomic transaction. And that atomicity is very important because these transactions are actually cut off at the end of the day, right? They only trade from 9:30 to 4. And when the close happens, what happens is like they have to settle. And oftentimes they don't. But atomicity means that both transactions either land or they revert. So it's a massive advantage. I know it's a little in the weeds there, but I think your listeners who are very sophisticated will understand what I'm talking about.
They're quite sophisticated. I think the shared ledger as well is an important piece of the Solana thesis because, in theory, I guess you could, on Ethereum, for example, the Ethereum layer 1 does not scale very well. You could create a quite performant L2 that can do similar things to what Solana does if you really locked in. And there are ones that are pretty fast right now. But sort of the issue is that these layer 2s do not share state as seamlessly as this one global L1 where all apps are built on top of it. And so I would think that's an important part of the Solana thesis, and like why would I build on Solana and not just launch my own L1 and get the L1 premium if I'm Stripe or some other fintech or whatever it is.
100%. I mean, one of the biggest advantages to the monolith, which is the Solana blockchain, is it does not fragment liquidity. Now, this is a pro and a con, right? It's a pro in that fragmenting liquidity is very costly. It's very bad. It's a con in that the blockchain is not necessarily you can't scale it as quickly than you can just spinning up a new L2, right? But that is why I think Anza, Firedancer, all the other guys that I've mentioned a million times are so focused on scaling fast, right? I think if anyone can actually make a monolithic chain, which has the superior attribute of composability and anti-fragmentation, if any group can do it, it is Solana. But like you mentioned Stripe's L1 earlier, right? Stripe's L1 is going to have to do two things. It's going to have to attract a robust ecosystem of different apps and different developers, right? That's hard to do, right? That's a challenge. And two, it's going to have to scale very fast with just a core contingent of core devs. And it's going to have to do it as fast as everyone else is doing it. So those are two big problems, because even though it is presumably going to be a monolithic chain, and so it captures all of the benefits of anti-fragmentation, it also has to be fast enough and scale fast enough to compete with Solana. But since it is still in its infancy, I think you can only say that Solana is the chain right now to beat.
Katana is an L2 built for DeFi, and it's pioneering the ecosystem category of productive TVL, believing that chains should be graded on how efficiently assets are put to work in DeFi, rather than just total value locked. In just a couple months, Katana has surpassed $500 million in TVL, with over 90% of that TVL being productive in ecosystem on apps like Sushi and Morpho, which also receive boosted yields from Katana's unique Vault Bridge design. From now until the end of November, users that bridge to Katana can earn boosted yield from CAT incentive campaigns, added Vault Bridge yield, and other chain revenue. Major app launches will be coming down the pipeline in the next few months, with incentive campaigns for the Kensei Memecoin Launchpad and Perpstex partners for Katana. With the launch of Katana's chain-wide V tokenomics model, VCAT holders will be at the middle of the Katana flywheel, directing emissions and earning fees for their votes from partner protocols. Thanks, Katana, for making this episode possible. As always, investments in blockchain technology involve risk. Terms and conditions apply. Do your own research. I also want to get your take on prop AMMs.
Sure.
When we talk about, Galaxy builds kind of high frequency trading infrastructure, one of the more interesting HFT-like developments on Solana recently has been these prop AMMs, where suddenly traders are getting much better prices than they could, a year and a half ago, or a little. I mean, maybe even just a year ago. If you look at when these prop AMMs started coming out,
it's about a year ago.
Where there's suddenly very sophisticated people sort of filling and market making for these trades. What's been your perspective on that development? Where do you see it going? I'm just curious what you think.
I think it's incredibly exciting. I mean, I'm low-key obsessed with prop AMMs. I think they're, and for the only reason is that like they give you better fills, right? They have tighter spreads. Right now, you can look at Binance and you can look at prop AMMs. And when you factor in the fees that you have to pay on Binance versus none of the fees that you have to pay out of a prop AMM, you get a tighter fill on a prop AMM on chain than Binance. I mean, think about that for a second. Like, this should be bigger news, right? Because historically, it has always been the case that assets trade worse on chain than Binance, right? Mm-hmm. This is the first instance where there are tighter spreads on chain than Binance. And so like, this is incredibly exciting. And if you think about it, it makes total sense. If what prop AMMs leverage here is an AMM structure, but with an oracle that is super dynamic. So what does that mean? If you can update the price of your AMM that you control privately 20, 30 times a slot, or even 100 times a slot, or even 100,000 times a slot. Think about this. It doesn't really matter if there's 400-second block times or, 20-second block times. Solana is continuous block building, right? So shreds are being processed continuously. And if the more updates that you can have and you can process in real time as a prop AMM, the more close or even better that the prices from the prop AMM can be to the centralized exchanges like Binance. So if you can update theoretically, right? If you could update your prop AMM's oracle 100,000 times a slot, you're better than Binance by far, right? You're rivaling Nasdaq in that case, because if you just look at cancels versus fills on Nasdaq and you look at changes in oracle pricing, it's a very rough proxy, but it's a good proxy. Prop AMMs are, I think, here to stay. I think they are the future. And I think what's so exciting about them as the head of DeFi is they're a uniquely DeFi primitive, right? Mm-hmm. They're a uniquely DeFi solution to a problem that has plagued DeFi since inception, really. Now, you can take that principle of prop AMMs and apply it to perps, right? You can apply it to lending, right? You're already seeing, I mean, you could actually argue that the original prop AMM wasn't an AMM at all. It was like the Morpho sort of curated vaults, right? It's the same principle, right? You've got a vault and you've got like this sort of risk engine attached to it that is privately run, right? So, but what's interesting about prop AMMs is they've innovated so much over the last 6 months to the point where now their oracle updates are so efficient that they have the ability of landing 10 to 15 times a slot. That's incredible. Now, what does that mean for DEXs? Your traditional DEXs. Mm-hmm. Well, it means that they have to compete with prop AMMs. They have to offer better opportunities. But I do still think that prop AMMs are not, at least from my perspective, going to be dabbling in what is really the most beautiful thing about DeFi, which doesn't exist in TradFi at all, which is DeFi's ability to price illiquid assets. This doesn't exist. Like, let's just take an example real quick and just give me 1 second on this. Like, there are millions of companies in the world that have private securities, and none of them have access to liquid markets. And the reason none of them have access to liquid markets is in part because of the securities laws. They can't freely trade, but it's also in part because market makers won't hold private securities, right? They just won't hold them. But DEXs can hold them, and they do hold them. So when you analogize a private security to a meme coin, all of a sudden you have the rails on chain that don't exist in TradFi to price illiquid assets. Let's take a real world example. Let's say you want to improve humanity. You want to build a solar field, solar farm, right? How do you raise capital to do it today? You got to go out and beg every rich person you know to write you a check. And you've got to promise them tax equity, it's called, right? And it's extremely grueling, extremely difficult, it's hard to do, and you're working in localized markets, right? The localized market you're working in is just who your Rolodex is, right? Now imagine this was instead converted to you're issuing tokens on chain. You're now moving from hyper-local markets to a global market. All of a sudden now you can potentially raise capital much easier for your solar farm, and you can tie it to on-chain distributions from that solar farm, right? So, but where would these things trade? In TradFi, there'd be no, even if you got the regulations in place on TradFi to be able to trade a solar farm's project finance equity shares, right? There'd be nowhere to trade them. You can't trade them on the Nasdaq. You'd have to register them. That would take years. You can't trade them anywhere. You could trade them on a DEX, on Solana, on Ethereum, on every, composable L1. So, and L2. And I think that's what's fascinating is that when you put DEXs together with prop AMMs and with market making and with Jupiter and with Titan and with DFlow and with all of these other aggregators, collectively, they are a decentralized Nasdaq already, right? They're all operating independently, but the result is something like one of the most performant decentralized stock exchange for non-stocks right now in the world. Now we're going to power up. We're going to get stocks trading on chain. It's just a regulatory issue at this point. But I suspect that Ford, what they will do, and this is per their public announcements, is they will issue tokenized Ford shares. And I'm willing to guess that those tokenized shares, if they're allowed to trade by the SEC, will have tighter spreads trading through prop AMMs than the spreads currently seen on Nasdaq. And if that happens, if a prop AMM issues tighter spreads than the Nasdaq, that's revolutionary right now. That is a game changer, right? It therefore means it's more beneficial for publicly traded companies to issue tokenized shares on Solana than it is on the Nasdaq. That is the game-changing moment, and I don't think it's that far away.
Okay. What is that prediction based on? That's a really interesting, to say that prop AMMs could actually achieve tighter spreads than what the Nasdaq could achieve. Is that due to the competition between the prop AMMs that exists? What actually drives those spreads to be as tight as they are?
It's a good question. Listen, if spreads started tightening on chain, obviously spreads would tighten on the Nasdaq, right? And it would be a little bit of an arms race, right? So that's more of an aspirational hope, right? And it's probably predicated on the assumption that the prop AMMs have something to prove, right?
Yeah.
They're going to tighten those spreads, in part to outcompete their competitors, right? But also in part to really build this future. So I don't want to say it would be charity, right? But right now, prop AMMs are quoting so tight because they're so competitive, right? These prop AMMs are in a dogfight to fill Jupiter or Titan or DFlow orders or OKX orders, right? There's this robust aggregator layer and meta aggregator layer. You interviewed Chris recently from Titan, which was, again, fantastic interview.
Thank you.
But it was, there is this really interesting architecture that is forming where meta aggregators and aggregators are almost acting like the price discovery layer, right? And DEXs and prop AMMs are acting like the market makers. And I think, given the level of competition, prop AMMs will quote Ford tighter. Now, that's just a prediction. It could be wrong. But if it happens, think about the efficiency of Ford rather than issuing an ATM on NASDAQ, meaning issuing new equity securities on NASDAQ. It issues tokenized Ford stock on chain. And let's say further, you can swap Solana for Ford stock. Think about this for a second. You've just cut out a ton of inefficiency there, right? Because what is Ford trying to do? On the NASDAQ, it's selling Ford stock to get dollars to buy SOL. On chain, it's selling Ford stock for SOL and then just holds it, right? It's a massive efficiency gain there.
Oh, yeah. Interesting.
Right? And then all of a sudden, you got to do a lot of other work with collateral, right? So you got to build up the lending markets for Ford and all this other rich ecosystem. But now you've got a monolithic blockchain with all of these different liquidity silos on the chain that are composable, that now you can start doing some very interesting things. And then one day there will be Ford perps, right? And there will be all this other stuff that's traded on chain. That's the hope. That's the future. The only question is, in the short term, how tight will the spreads be? And that is the question for all the prop AMMs is, are you willing to win this game? And the game isn't between yourselves. The game is between market makers on NASDAQ.
Well put. Well put. Man, I feel like we've covered a ton of ground. I'm almost like grasping at how to put a nice bow on this one. One piece we haven't touched on that I'm curious about is like Galaxy, to my understanding, and today announced GalaxyOne, this kind of new app that it's putting out, led by Zach Prince, formerly from BlockFi. How does the Galaxy business model factor into this world, where you're kind of, to my understanding, is like just a one-stop holistic crypto shop, crypto as a service? I don't exactly know how I would put your business model, but like, where does that factor in if we could go in that direction for a second?
So Galaxy is like a hybrid of many different crypto type businesses, but also non-crypto type businesses, right? So Galaxy, first and foremost, is a trading shop. We've got one of the largest OTC desks in the world. We have market making, we have DeFi. We also have staking, right? So it does all these things. We also have an investment bank. So like if Blockworks wants to sell itself, right, you go to Galaxy investment bankers and you say, hey, we're looking to sell. Bankers, what's the market look like? Give me advice on this stuff, right? And it only represents cryptos. It also has one of the largest, most successful asset management divisions on the street for crypto. And this is what's really providing everything from providing treasury management services to the DATs to having provided having been the sole asset manager to the FTX estate when they put their entire management either in jail or on trial. And so we can serve a lot of different areas. And of course, within asset management, we also have ventures, right? We have a lot of different things. And the thesis there was, I think, if we're going to bridge TradFi institutions to crypto, we need to be in every pocket where institutions care about. We need to be on the cutting edge with ventures, right? We also need to have an OTC market when institutions come to us, they want to buy crypto. So it's a conglomerate, really. It's got a lot of different businesses within it, but they all work together, right? In a lot of ways, right? Like, so we get a lot of strategic leverage by being able to have a staking division and a DeFi division, right? We get a lot of strategic leverage from having a staking division and an OTC shop, because now think about this. If you're looking to unstake as an institution, what do you care about? Whether or not you can get your tokens back quickly. A staking company alone doesn't have the balance sheet to be able to bridge that liquidity over the bonding and unbonding period. But Galaxy does, right? Galaxy can make that bridge. And so one of the really impressive, incredible things that Galaxy staking does is it provides instant liquidity. So you need to unbond. You don't want to wait 2.5 days from Solana. You want it right away. We'll get you it, right? That can only happen when you pair a staking business with a balance sheet, when you pair a staking business with an OTC business, when you pair a staking business with an asset management business, right? And all of these different businesses working together. Now, we also have a data center business, which is incredibly exciting. Now, that was birthed from the acquisition of the Helios campus, which was a Bitcoin mining site, right? So we also used to have a really incredible Bitcoin mining facility. But that also is a story that relates to what we're talking about. It dovetails nicely in that, why were we able to be successful Bitcoin mining actors? Well, we did something that actually wasn't really done that often. Bitcoin miners around 2021 and 2022, they didn't hedge their Bitcoin. And they didn't hedge their energy exposure, right? Bitcoin miners, they were very exposed to the prices of energy. But if you think about it for 2 seconds, it's actually kind of hard for a standard Bitcoin mining company that is really smart about running Bitcoin miners to be able to hedge their exposure to energy prices. But Galaxy had a Bitcoin mining facility and our energy traders, right? And our trading shop with a big balance sheet. So what we did on day one is we entered into a fixed term power purchase agreement where we actually had this incredible thing, which to this day I'm very proud of, and I think it's awesome, is we had this system set up, which is when the price of Bitcoin exceeded the price of energy on the free market in Texas, we turned our Bitcoin miners on and started printing Bitcoin. When the energy price exceeded the price of Bitcoin, we turned our miners off and we sold power back to the grid. We never lost money, right, during this, right? The biggest risk for Bitcoin miners was that when the price of energy in a free market exceeds the price of Bitcoin, they just have to turn off their Bitcoin miners and just sit there, right? And that could happen all the time. Like when Russia invaded Ukraine, right? And energy prices went through the roof. Like these guys are stuck. And they can't at that point enter into a fixed power purchase agreement, right? It's too late by that. We got in there immediately because we had a big balance sheet and because we have trading capabilities. So we had all of this different stuff, and it's a story that needs to be told more about the synergies between the different businesses, right? Like one of the big metas over the next 5-10 years for crypto, it's obviously a meta for everything else, but for crypto is the intersection between crypto and AI. Who is better positioned to excel at that than Galaxy that will run one of the largest AI data centers in the world, right? Like the opportunity is massive, I believe, and I'm hopeful for it. And it's exciting because all of these different parts of the business actually really work very well together and position Galaxy in quite a powerful way. And you're seeing that right now, right? Like you're seeing it happen right now it seems like we're announcing new things every day. G1 is just the latest, which is very cool. It's going to be a tremendous success, I think. I'm very hopeful that people will like it. And while I haven't been that close to it, I do get a lot of like positive vibes from that team. They're really working hard. It's a big team, and I think they're going to be very successful.
Is the one on your cap like a GalaxyOne reference, or is that an unrelated one?
It is good call out. Yeah. I am wearing a GalaxyOne hat right now.
Oh, there we go. Yeah.
But this is a fantastic hat. Like just very comfortable.
Were you allowed to wear it before today? Like this was, not known.
Yeah. I've had this for about a year.
Oh, so GalaxyOne has been in the works for a long time.
Oh yeah, it's been in the works for a while.
Okay.
Yeah, for sure. But like it's taken different iterations, right?
Yeah.
So it's this interesting platform, right, where we're going to offer accredited investors like 8% yield on their deposits, which I don't think anyone else in the market is really doing. And that what powers it is, here's a beautiful example. What powers it is we have probably the biggest crypto lending operation on the street, right? And so we can actually pass those yields on to institutional investors and accredited investors. And so that's a really exciting thing. And so like our lending is synergistic with our G1 platform, right? Which is also synergistic with, by the way, our data center, right? And with our Bitcoin mining facility previously, right? Like all these things actually come together in a really positive way.
It's interesting, and this might be sort of beyond your realm of expertise with Galaxy, but it's almost like you're describing to me Coinbase, but without the exchange part, which is interesting to me because, I mean, especially in a Solana context, there's a bit of a tension with Coinbase and Solana where Coinbase has its own layer 2 that competes for a lot of the same users and use cases that Solana does. And so there's always been a bit of a troubled relationship there. And I've always thought that there's really an opportunity to build like an exchange that is more favored with the Solana community. I think Kraken has really put some work into doing this, but even Kraken has its own L2 at this point. So it's like, I almost wonder if Galaxy is a Coinbase-like bet on Solana or something. I wonder if there's something there.
I've never heard that. That's quite interesting. I will say Coinbase ships. They're a phenomenal shop, right? And yes, there's been high tensions between Coinbase and Solana historically. I take them at their word, and I think they're acting in good faith that like they just had some tech issues on the Solana side. As a builder on Solana, it's not the easiest place to build oftentimes, right? So, but Coinbase has been a leader and just a tremendous even partner to Galaxy in a lot of things. Like they took on the Gensler administration, right, and the SEC. Like Paul Grewal is one of the most based individuals in all of crypto, right? Like that guy deserves so much props and leadership. And of course, Armstrong is just a phenomenal leader. So Coinbase is fantastic, and I love what they're doing on Base, right? Base is fantastic. Whether it can scale faster than Solana is a question about whether a decentralized network of actors operating independently, but for a shared goal and through decentralized coordination can innovate faster than a more centralized system, right? I don't want to say that Base is totally centralized. I think Coinbase people would be quite pissed at me about that. And it's more decentralized than like AWS, obviously, right? But the L2s need shared sequencing. Like, just to give you my thought on this, like, they need shared sequencing. It has to happen. And base rollups are a very good step in that direction, but they need to decentralize the sequencer. I don't know if they ever can, because the sequencers make a lot of money on being centralized, right? Now, why is it easier to decentralize a decentralized network already than to decentralize a centralized network? Because if Anza tells the validators, right, like, hey, these are some changes that are going to be made, I know you had 400 milliseconds to build a block, but now you only have 100 milliseconds to build it. Like, the validators are so disparate, right? And they're not organized because they're decentralized, that like they're going to comply with those rules for the most part, right? It's much easier to get a supermajority support on Solana across a decentralized network than it is to get one centralized sequencer to decentralize. So they need to decentralize. I think they are in like what? Like, I think what the ETH community says is they're in like stage 1 or something, or like of their decentralization thesis. Let's go. Like, I think we gotta move on that here. And what it unlocks for companies like Base is like a tremendous amount of upside. Like, if you can decentralize sufficiently, then you can start trading tokenized securities, right? Because I do not think, and this is a controversial take, but I do not think, based on having studied the Securities and Exchange Act of 1934, quite extensively, Sarbanes-Oxley, Reg NMS, all the different.
You're a lawyer is something that
I am a
we should have
lawyer.
noted.
I just think that it is highly unlikely that this SEC, even though it's far more favorable, is going to say that any centralized system that ultimately has, at the end of the day, the authority to determine certain set of circumscribed actions. And I'm not saying Base has, or anyone, I'm not picking on Base here. Base is working hard to decentralize, I think. But any L2, like, it is very difficult for me to believe that that they will be able to get the regulatory clearance to trade tokenized securities, because they are ultimately controlled by certain central authorities that could register them, right? So like, Lily is the president of Solana. She can't register Solana as like a broker dealer or as a like ATS, right? Like, you can't do that. It doesn't make sense. And so like, you can't do it. Like, Vitalik can't register the Ethereum network to be compliant with the securities laws, right? By the same token, Hayden can't register Uniswap, the protocol, as a registered broker-dealer or registered exchange. It can't do it. It's decentralized. It's impossible. But you certainly could do that for a centralized L2, right? And so I do think that that once the L2s do decentralize, you're going to see more of that. And here's the reason why. Like, just let me make it very plain. If the SEC were to allow a centralized chain, L2, let's say, but also it applies to L1s as well. Like, if it were to allow a centralized chain to trade tokenized securities without registering as an exchange or broker dealer or under any of the applicable regulations, what does that say to Nasdaq, right? Nasdaq will immediately launch an L2 and circumvent all of the existing rules that it has to apply with, right? Like, it's not hard for Nasdaq to launch a fork of Optimism right now, right? And so, unless you want to completely cast away the 90 years of securities regulations, you're going to have a limiting principle on where tokenized stocks can trade and where they can't. And I think the SEC, is going to take up this issue hopefully soon. But I think a very sound basis for a limiting principle is the network sufficiently decentralized? And are the protocols on that network sufficiently autonomous? Because if the protocols are autonomous and the network is decentralized, there is nothing to regulate. And the core concerns of the 34 Act actually are not concerns in this environment, because you have eliminated human fraud, right? Because humans cannot intercede into this market.
Interesting. What about, like, to push this a little further, you mentioned like base rollups, where, to my understanding, like some of the sequencing that happens with the transactions is then pushed to the base layer, to Ethereum layer 1. And so, someone who is a fan of Ethereum might argue this actually prevents like one single entity from stopping transacting on some layer 2, because the Ethereum layer 1 is very decentralized, and so everything has to settle on that layer anyways. What do you make of that argument?
I think it's a sound argument, right? I think base rollups, unfortunately, haven't really taken off as much as you would think, given this property. But also, there hasn't been really the need yet, because tokenized securities are still in their infancy, right? Like, what I'm saying here is that L2s are really powerful for a lot of different things. And they are a way that Ethereum can scale. But they scale at the risk of fragmentation, right? And capital fragmentation, and they scale at the risk of centralization. Base sequencers and base L2s, I think, are a potentially good solution to the centralized sequencer problem. I'm sure that there are challenges there, or else I think they would have taken off more. But also at the same time, like, there's the ZK thesis, right? I mean, there's a lot, like the fraud proofs versus ZKs. Like, why haven't ZKs like totally supplanted fraud proofs, right? And why haven't fraud proofs actually really actually worked thus far? There's a lot of like maybe threshold issues that have to exist before base sequencers really come on. But I will tell you that the more that the L1 is processing and the less that a centralized intermediary is processing, the better facts are available for trading securities on an L2.
Yeah. I also think there's this revealed preferences thing going on a little bit, where I don't know if traders really care that much if, there's this, like, I don't think traders on base care if base uses a centralized sequencer or a based sequencer. Like, I think that traders often, in the real world, are attracted to incentives. They're attracted to apps that they want to use, things like this. I guess it gets a little more complicated if you talk about like what a more institutional investor who's using these things might want to do. I still doubt that it would, or I don't know. I wonder how much it would really matter to them.
I think institutions will have a lot more comfort with L2s that are centralized at first, right? Because they're used to trading on centralized systems. And to the extent that those L2s can decentralize over time, it's a nice little red pill of institutions to slowly moving them over to the decentralized world. Of course, what do institutions like to trade, right? Like, they like to trade securities and commodities and bonds and currencies. And so, like, to the extent that securities can't trade on centralized L2s, that's going to be a big bottleneck for institutions trading on L2s. There was a thesis a couple of years ago coming from big institutions that permission blockchains were the future. Mm-hmm. You don't really hear much about permission blockchain anymore as much. And I think that's in part because permission blockchains could not scale nearly as successfully as decentralized networks. They could not match the speed and the innovation of decentralized networks, which is exactly why we're all in crypto. It's because decentralized networks unlock a massive amount of innovation because they're able to coordinate decentralized actors for a shared goal, right? Like, Helium is one of the coolest projects on Solana, right? Think about for a second, if you wanted to take on the global utility or the national utilities, right? You wanted to take on Verizon and you wanted to build a Verizon competitor. Well, first of all, the amount of regulations you have to sift through, the amount of central planning and coordination you have to sift through, the amount of lobbyists that you have to hire, the amount of infrastructure and how long it's going to take. And it's a lot for any one company to do, which is why these are more like utilities now than privately traded, privately owned companies, because they have a moat that is like almost insurmountable if you're going at it the same way everyone else is going at it. But if you're Helium and you're leveraging the power of decentralized networks, you create a Helium hotspot, right? And all you do, you issue a token. And the token is meant to incentivize your conduct, right? All you have to do is plug the hotspot into the wall and you will be providing broadband for the network. All of a sudden, with some infrastructure improvements over time, that network could potentially be more successful, more prevalent, without having to sift through any of the regulatory muck. Like, you don't have to lay fiber optic cables, right? You can almost vampire attack the existing infrastructure for Helium hotspots. I mean, the other example with Helium is like their Google sort of maps, right? Which like they incentivize people to like take pictures around the world while they're driving their cars through Helium. Like, that actually is far, from what I understand, that is actually very successful in competing with Google's, globally distributed, picture, whatever, the satellite imagery, right? So cool. And they're doing it through totally decentralized, permissionless networks. And like, I would just add this final thing, Jack, on this piece. This is not just an economic powerhouse. This is not just an economic advantage that decentralized networks have. This is a political advantage that decentralized networks have, right? Like, if you're going to take on the legacy industries, not having a head to chop off of the snake, right, is very important. Like, I still think the legacy TradFi institutional apparatus doesn't know how to deal with crypto because they don't know who to attack. They don't know who to go after, right? Like, you could take out me or you or anyone in crypto. Crypto's still going on, right? Crypto's still marching forward. It's a political movement. It's a leaderless political movement, right? If you think about it. And what is the political movement? It is to overthrow the existing financial system and move it on-chain. And on-chain is the end goal because on-chain is permissionless, it's transparent, it's more fair, it's more free. And I think that is the beauty of what we are all participating in crypto, is that we are not only economic actors building economic tools, we are political revolutionaries. We are actively engaged in a political battle without even realizing it at times. And changing a broken, fractured, monopolistic, entrenched system that is often quite corrupt in favor of a free and transparent system. And obviously, like, that's a romanticization of what crypto is, right? That's crypto at its best and probably couching TradFi at its worst. But I do think there's a lot of core features of TradFi that would benefit a lot from moving on chain.
Yeah. Okay. Michael, we are over time here, but in true Solana fashion, there's kind of a tradition in the Solana world of being maybe in good faith critical of the things that you're talking about, and we've gotten a lot of bullishness today, a lot of why Solana is the network of the future. Give me one thing that you think Solana needs to improve on. Like, if this political battle that you've described to me over the past 90 minutes now almost is going to come to fruition, like, what is one tangible change that needs to happen?
So I think the biggest risk for Solana is that they don't ship fast enough and that there's tremendous infighting between Anza, between Firedancer, between ecosystem players. I don't have any evidence of this, but like, for the matter is, like, here's the fact. They got to get on the same page and they got to ship. And they got to ship fast, right? Like, we can't be having skirmishes about like whether or not we should increase the CU limit to 80 million CUs or keep it at 60 million CUs. We can't be skirmishing about like whether or not we should, be limiting block times to 400 milliseconds or reducing to 300 milliseconds, right? Like, there's a lot of like little super technical questions that like we just got to land on an answer and you got to move forward. Because one of the things we saw historically on other blockchains has been infighting about the philosophy and direction of the chain cannibalized the efforts of the chain, right? So the most important thing that this chain can do is get on the same page and be militant about shipping and ship or die. They need to ship or die. All actors do. I will say the other thing is that when you're really successful, you're sometimes the victim of your own success, right? Mm-hmm. So like developers that are like working, eating ramen noodles, like tend to, like making little money, but have a big dream and a big vision, tend to work harder than millionaire devs that have a giant bag of whatever token that they have, right? I will say that like the way to cut through that, because I do want developers and the core devs and everyone to be like, really reaping the fruits of their labor because they've gotten us this far, is like, think about the bigger picture here, right? Like, it's not just like optimizing this, this piece of a network or, minimizing latency here. It's about competing for the biggest prize out there. And so like, they've got to be very focused on and frankly, Galaxy as well. We have to be very focused on shipping, building, organizing, staying on the same page, and ignoring whatever bags that you've accumulated in the past. Those bags are tiny compared to the bags that await if you can get the $500 trillion securities market and the global capital markets. The internet capital markets thesis is alive and well if we can seize it.
Ask not what your bags can do for you, ask what you can do for your bags.
Exactly.
Michael Marcantonio, head of DeFi at Galaxy. Thanks for coming. Thanks for bringing the energy today. This is a fun one.
Appreciate it.
Really good time having you.
Thanks a lot, my man.
Thank you, everyone. If you made it this far into the episode, we would love if you gave this episode a like or a 5-star review wherever you get your podcasts. If you enjoy this podcast, please share it with a friend, and we will see you all again very soon.